Hey, it's Wes Stearns. Today I want to talk to you about short sales. And nothing about short sales is quick and short. It's a horrible description. I want to point out an example of one of the cases to help highlight some of the challenges of short sales. Let's imagine someone in 2005 bought a house and financed $500,000, and they did an 80-20 loan. So their first mortgage was 80% at $400,000, and they did a 20% second mortgage for $100,000. The market tanked 2008, 2009, it dropped. Now the house, they got an offer at $375. In a short sale, basically, the seller is upside down and they're unable to make those mortgage payments. It's in the bank's or the investor's best interest to do a short sale instead of foreclosure, and I'll explain that in a minute. So let's say the market's dropped and the seller now can sell it for $375. The seller's going to sign the offer just to delay or cancel the foreclosure proceedings. That doesn't mean it's a done deal. There's a process, and the investor, or investors in this case, there's a first investor and a second investor, they need to approve the short sale or the payoff. So in this case, with the offer of $375, the paperwork's going to be done. This is usually 2 months after the contract signed for the short sale. The bank is going to want to see diligence to see if the seller has a hardship. Is the seller upside down? Did they lose their job? Can they afford the mortgage payment? Do they have other assets that will help catch them up and pay for the mortgage payment? If not, they'll look at all the documents. They'll send a broker out to do a quick valuation on the property to make sure $375 is a good offer. Once they do that and they do all the diligence, then they're going to approach the investor, the guy that gave $400,000 for these people for the loan, and say, look, we've determined $375 is a good offer price based on the commissions, other fees, the arrears on taxes and HOA. We're now going to give you, Mr. Investor, $340,000. And the investor gave $400,000. So he or she needs to approve that $60,000 loss. All right. The second mortgage, or the second investor, gave $100,000. Now this investor's offered maybe $2,000 or $2,500, and he or she needs to approve it. Why would the investor that gave $100,000 take $2,500? Well, the way of foreclosure, if they don't approve this, they can't work it out, and both parties are agreeable for their payoff, the house goes to foreclosure. The attorney and the taxes are paid first. Then what money is left, the first mortgage or first investor will get what's left. Okay. If there's anything left over, the second investor will get something. So at $2,500, or where this price went from $500 down to $375, there may not be $2,500 left if it goes to foreclosure. So the second investor needs to take the $2,500 to cooperate. This can get really messy. Now we're at months 4, 5, and 6 where the other investor is not cooperating. He wants more than $2,500. So it's almost like playing chicken on the railroad. It can be very time consuming to work this out. Another interesting caveat to short sales. Maybe this investor is using this property which he or she is not getting any mortgage payment. The homeowner has not made a mortgage payment in 8 months. And you think, well, gosh, shouldn't he take something instead of nothing? Well, maybe this investor is a multimillionaire and he or she is using this property that's not have any income coming, write it off on their taxes as a non-performing asset. So the investor may be making $5 million over here, but on this side of the ledger, they can show this mortgage that they're not getting paid for, and they use it as a tax write-off. So it doesn't make sense at times when you look at it and say, hey, they haven't been paid in 8 months, they should do the short sale. So any one of these investors can mess it up. With this offer, 3 or 4 months down the road, the investor can say, you know what, I don't want $340, I want $380. And all of a sudden the realtor contacts the buyer agent and say, look, we need $40,000 more on this $375 deal. The house may not be worth it. Okay. A couple of other challenges, and I'll wrap up. The timing. It can be, if you need a house within 2 or 3 months, a short sale is not for you. The last two I have averaged 9 to 18 months to get a short sale done. Also, if the investor is going to lose $60,000 or $97,500, they're not fixing anything, and the seller is not fixing anything. They want to be free and clear, walk away from the house. So you're buying the house as is. Don't expect any repairs. And then the other unfortunate thing, you could be waiting 4 or 5 months, and then all of a sudden the investors say, hey, I'm not going to work. I'd love to see your comments or questions. Place them below and subscribe for more topics regarding real estate. Thank you.